Um, Gonna get started here in just a minute as I get some viewers. I see we're at zero. There we are. Right. All right. Good to see everybody. So today we're covering tax planning for Canadian small businesses, and I'm really excited to get started here. I think everybody can see me, uh, and we'll get started right away. For those who don't know me, my name is Joe, and I'm the owner and a founder here at Avalon Accounting. So, Avalon Accounting, we're a small firm, a remote firm across Canada, and we provide accounting, bookkeeping, and payroll services to small businesses in Canada, and uh, we also run a YouTube channel, as you can see. So thanks for your support on it. We do that to one support our clients. We get the same questions over and over again, and I think it's useful for our current clients. But then our mission here at Avalon as well is to help small business owners thrive. So it's a really great way for us to help the larger community by answering the common questions that we get and some of the confusions around tax and finance and just running a small business in general. So that's our goal with Avalon. So hopefully getting some use out of our content. We always love comments and questions, and we try to make use of those and get answers to you when we can. But that's me in a nutshell. And today we're covering tax planning for small businesses. And we'll do it's going to be a broad overview. This isn't tax advice, so just be a little careful. We're not giving specific tax advice for anybody. Just giving you some ideas and things to think about and to approach your accountant with, or to have just more context on what constitutes tax planning here in Canada and what's available to you. So I think the main thing to we'll get started here. I'll just put actually share my presentation here as well as a slideshow. Here we go. Yeah. Oh, sorry. I got to go back. Here, I was planning it. Let me get started here. First slide for a change. There we go. So, yeah, key tax planning strategies. So, when we talk about tax planning, what we're talking about is sort of tax minimization. And often that means minimizing your tax over your lifetime or delaying tax until a future date. So, it's not always about complete reduction. We can't eliminate all taxes with tax planning or being clever, but the idea is that if we can delay it, we can hold on to our money longer and we can make that money work for us to build wealth. So that's the idea. If we can push that tax bill off to the future, we can retain some of that money, maybe hire more people, buy more equipment, reinvest in our business, or invest in other businesses. Like in stock market and things like that, or property and whatnot. So using that tax minimization strategy to build wealth. So that's the general idea. And the goal today is to just make you aware of some of the strategies that are available to small business owners, and how we might utilize those from sort of easiest to hardest, I guess, is the way I'm going to approach this. But we'll have time for questions. But if you have a question in the meantime or something that needs to clarify, just let me know here in the chat, and I'll do my best to integrate that into the conversation. I'm not reading from a script or anything. This is straight up from my notes and bringing this presentation to you. So if you do have questions, please throw them in the chat, and that's going to enhance our conversation here. All right. So today, the things we're going to cover is tax planning for sole proprietorships versus corporations. That's one of the big ones, and it's more of a continuum than anything. One doesn't, one sort of blends into the other, and are available to both. But some things are specifically for corporations, and then we'll get into key tax planning considerations, things to think about when you're thinking about tax planning or minimizing tax. We're going to master the basics first and then go through some of the strategies you can use. And I've actually got a couple real life examples, some really common sort of situations that we would find a client in and how those would unfold with tax planning. And then we'll also have a dedicated time for Q&A. So think it will run probably about 45, 50 minutes total. I don't have much more time than that today, but any questions that are left in the comments there, we'll try to get to a Q&A on Instagram later, put those on there and answer some of those questions on our Instagram channel as well. So please go and follow there. I think that's the terminology. Right. So first up, small business basics of small business taxation. So it's important to understand what the difference is between sole proprietorships and corporations is. So with a sole proprietorship, you're just getting taxed at your personal marginal tax rate every year. All your profit is just going straight to your personal tax bill. Whereas corporations, small corporations, small business corporations in Canada get taxed at a much lower tax rate to retain more of that income that they can use to grow their business. Whereas sole proprietors, if you're making lots of money in a sole proprietorship, you're going to be paying a big chunk of that in tax because the marginal rate would be quite high, anything over about 156,000, and you're looking at upwards of 50% marginal tax rate. So that's the big difference between sole proprietorships and corporations, and one of the reasons we push to corporations if you are growing a business. Um, and then the impact on tax planning opportunities. So as we incorporate, there are tax planning strategies for sole proprietors, and we'll go through those. But once we sort of outgrow those, we have other tax planning strategies that involve corporations and must have a corporation. So we'll be dedicating quite a bit of time today on those. And then the importance of choosing the right structure. So kind of go through, I think, well, actually, this is probably a good time to just say, for sole proprietors, you're really looking at, when you have more income than you know what to do with, you do really need to incorporate at that point. But if you're just running, a smaller business, maybe a services business or something like that, and it's just you, maybe a couple employees, there might not be a good reason to incorporate in that circumstance because you'll be able to use some of the more accessible tax planning strategies to avoid paying high tax rates through your highest income earning years. All right. So these are the big considerations, especially for incorporating, and we will go through that in detail. But what's your long term intention with the business? So I kind of think of the plumbing business that may or may not grow into its own brand and its own business apart from the plumbing owner, and they may just want to do their services, make their income, and not worry about growing a business into something beyond themselves. So you got to think about your long-term intention with your business. I think is super important. There's also cash flow considerations. What's available to you at given time to almost invest in tax planning as well. Some of the strategies that we'll look at today, you need consistent cash flow in order to keep going. And likewise, even with incorporation, I mean, there is a cost associated with incorporating that you want, to offset the taxes that you'll actually save and what's available to you based on the increased administration costs and things like that of incorporating. So super important to think about those things. And then even at the higher levels. So if you are looking at we'll cover insurance plans and things like that. Cost to implement these things, or we won't cover trust today. But if you are looking at a trust for tax planning for the future and estate planning, there's cost associated with that. So you want to make sure that it makes sense for your tax situation, and that's not an easy black and white thing to cover, but to know that those options are available, but they do come at an additional cost. So as we rank up these tax planning strategies, the more cost is associated with them, because the risk is a little bit higher in the structure. You need professionals to do those things and maintain them. So the cost to implement can be quite a bit higher. So you want to make sure the tax savings are actually worth it. You're making the kind of income that you would need to offset the cost to have those strategies. Right. So next slide here. So the number one thing when we think about tax planning, and often these conversations kind of skip this point, and I think it's actually really important, is that it can happen throughout the year. It has to happen early. It's about communicating with your professional, so your accountant or your financial planner or lawyer, or whoever you have looking after your tax situation. That you talk to them early about what your plans are, your next 3 years, 5 years, 10 years. What you're trying to accomplish with your business and what your personal situation is. I know we can kind of feel like therapists sometimes as accountants, but we do really want that close relationship so that we do understand, what's happening with your children, and are they going to be going to university, or are you maybe someone you're having a child coming up, or you're saving for a home, or lots of personal things that are happening, that can help your accountants give you some good advice with that. But it's super important, and I think it's overlooked to think about maintaining accurate financial records. It's actually really crucial to know what's going on throughout the year to give good advice, and I think a lot of business owners forget this because, there's an annual cycle to getting your tax return done, so it becomes accurate only once a year. And there are costs associated with that. I understand hiring a professional bookkeeper or an accountant to maintain things throughout the year can be an additional cost. But it's also, I think, important for tax planning considerations, that you have someone taking care of your books. So you have a good financial picture of your business, so that they can give you appropriate advice. And understanding that if that's outside of your price range, you can't keep monthly bookkeeping, or pay an accountant to actually work for you throughout the year, that you may miss out on some of those opportunities. And that's just the reality of, whether someone's really looking forward to looking after you throughout the year, or someone swooping in at the end of the year after everything's done and just filing your tax return and saying, oh yeah, you know what, you could have saved some tax back in December by doing this thing or that thing or the other thing. So I think it's a super important thing, just even to set expectations for yourself, that if you aren't keeping things up to date on a month to month basis, that you may be missing out on those opportunities. And it's really up to you to decide whether that's worth it for you to keep things up to date throughout the year, or it's not. Um, so that's super important. And then I think what's also important is that just common tax deductions available to small businesses. So, making sure that you are capturing all of the expenses that you incur for your business, super important. And should go without saying, but I don't know if it necessarily does. We all get busy. Maybe use your personal card for business transactions, or if you're a sole proprietor, maybe you're blending business and personal, and then it's hard to pull out what's actually business. And people can err on one side of that or the other. So sometimes you find that people may expense too much, you know, erring on the side of, I'm going to expense everything, even personal stuff, and others that are like, it's not worth it to submit all my receipts, or keep my receipts, or keep track of this stuff. And if I pay a little bit of extra tax, that's okay. That I think that's, there's a simple solution, and just keeping things up to date, making sure you're getting all your tax deductions. And then there's other ones like, staff parties and things like that that could be deducted at 100% versus 50% that you really want to watch for. um, and yeah, then gifts, for example, for your employees, making sure those are deducted, and that as well. So there's lots of deductions there. We have a whole list, but the takeaway here is to keep bookkeeping up to date. Make sure you're keeping track of your expenses. Don't miss out on tax deductions, because that reduces your net income, which directly reduces your tax bill. And it's not something to be overlooked when it comes to tax planning, which is, you know, a major part and kind of a simple, basic, foundational thing. Make sure you get all your expenses in so you don't pay more tax than you should. Yeah, and then, like I said, with um, keeping a professional bookkeeper and accountant and payroll specialist, you can avoid things like penalties as well, and especially for payroll. Like part of it isn't just getting your deductions; it's avoiding penalties. And payroll is the worst. So if you miss a remittance on the 15th of the following month and you were supposed to pay that, the penalties can be crucial. And so just one of those can wipe out any tax savings that you've worked so hard for. So really important to stay on top of those things. Pay GST on time, pay your payroll remittances on time, file T2s and everything. Oh yeah, Heather, sorry. Yeah, there is actually a full full list of eligible tax deductions. And I do have a whole video on what you can deduct for taxes. And it's not just kind of a, I guess it's hard to say a list because every business is different. But there are some common things in our blog post, which I can post here, that that are commonly missed, but really any expense that is related to your business. And it's really about being related to earning income. So if you could think it's directly related, you wouldn't spend that money other than, for your business, immediately deductible, except where there's, specific exceptions like membership dues and a few things like clubs and golf clubs and things like that. So we do have a blog post on that, and I do have a video on that as well. So I can post that here in a minute. Or if I have any Avalonians watching right now, you can post the link in the comments. That would be awesome. Thank you. Right. So yes, basics first. Get the basics. All right. So, sole proprietors, corporate owners, I think the thing that, again, we're going from really simple to more complex. But RSPs and TFSAs, super important not to forget about these. And this is what I'm talking about for sole proprietors, especially where, if you're making $150,000 a year or less, maybe even like $180,000 a year or less, you don't necessarily need to incorporate unless you're planning on building a business that you might sell later. So it's super important because you can use RSPs. That is something that is available to you, is cheap, and is super effective. And I think of, tax minimization or tax deferral as how much of your money can you hold on to right now. So, you have RSPs. You put that money into an RSP and you retain 100% of the capital of that because you pay zero tax on that as long as you have RSP contribution space. So it's a super effective and efficient way to defer your tax till later life. And the idea there is that in your later life, your income or early life, I just made $6.85 in my first job, not making a lot of money. But my tax rate's super low because, I barely make the personal amount during that year. So tax rates are low. But then in your higher income years, you're hopefully saving some money in that times for your retirement and whatnot. And what the government allows you to do is sort of cut the top of that income level off because they'd be at high marginal tax rates and plonk them onto the end of your life where your income's going to be low again. So you kind of keep a lower average marginal rate over your lifetime. It's not a perfect science because we don't know what the future holds. Maybe, you hit the lottery and you have passive income that puts you into a high marginal tax rate in your dotage. But uh, you can't really prepare for that. So the idea is that generally speaking, your income's gonna be lower later in life. So we want to cut the top of those top earning income years. And the most effective way to do that is through RSPs because you put that money in, you get 100% deduction on your income. And that's unmatched. That's really unmatched when it comes to tax deferral, but it's limited. I mean, if you start making, you know, 200, $300,000 a year, you're going to run out of contribution space, and that's going to be very limited in how you can use it. But still very effective, and that's why I don't want to skip it. TFSAs, same thing. You get taxed on the money that goes in there, but then any growth and that within the TFSA is tax free. So super helpful there. And again, cheap. A dime a dozen. You can go to Wealthsimple and open an account right now, plunk in some money into your RSP and TFSA, almost zero cost to you, and you're off to the races getting those deductions. So well established, and the risk is almost zero. Like, what government's ever going to get rid of TFSAs and RSPs? It's probably never going to happen. So super important to take that into consideration as well. How much risk is involved in these tax planning strategies? That the government has a change of heart. We could get an NDP government that doesn't like RSPs being that high. They want to tax people, anybody making more than $100,000 a year, for example. That could be something that could come through. You don't know. So these things can change, but they'll more likely to be changed as they get more complex. So then once we're past the TFSA RSP sort of window, we're looking at incorporation, and it's not just about tax deferral here, although there's a component of it. But if you're looking at selling your business one day, if you're building a business that is going to have value to somebody else and is part of your wealth growth strategy, super important just to incorporate. I think, like, it's a no-brainer because there are such tax opportunities there. One being you can grow faster because you retain more of your income, and I'll go through the numbers of that in a second. Um, but also lifetime capital gains exemption. So you sell your business later to somebody, and you have over $900,000 in tax-free capital gains for selling the shares of a small business corporation in Canada, qualified small business corporation. Obviously, there's rules to that. It's not like every business, but it does cover a good a chunk of small businesses, and what you would think would be a small business in Canada. And I'll go through a little bit of detail there on one of my examples on how we used a holding company to make sure we had lifetime capital gains exemption hold on to for the business owner. But incorporation is a good strategy for that. So if you're growing that business, it's part of your wealth strategy. You might sell it one day. It's going to have value to somebody else. Super important to incorporate because you won't get that with a sole proprietorship. The other is, again, if you're trying to build wealth, you want to hold on to as much of that money as possible. Here in BC, it's the small business tax rate's 11%. I think in Ontario it's 12 point something. So really low corporate tax rate. And the reason why, I mean, it's not like the government loves corporations and loves to do, good by them. It's good for the economy. And I think it's good to understand the policy intent behind these tax rates and things is that small businesses, they don't make a ton of money generally. There's a $500,000 limit to the small business deduction. But the idea is that if you can retain more of your income within the corporation, you can buy more equipment, you can hire more people, you can retain more of that income as long as it's being put to use to grow the economy. And that's their intention there. It's not to make you rich, although they do want to reward people who take the risk to start their business in limited ways, as we'll see. And as the Liberal government's sort of done over the last few years, they've limited the incentive to start a business. But there's still some good incentives there, which are that those low tax rates where you can grow a really valuable business over the course of 10, 15 years that you can sell maybe for $1 million and pay minimal tax on that, almost nothing. Which is, I mean, is a big part of lots of people's retirement strategy is to grow a business that they can sell one day. And you do that through a corporation and through the lifetime capital gains exemption. And you can grow faster because you get the small business tax rate. Uh, you can use it for investments as well. I think people automatically go to that. Like, they're they have their business and they get, 11% tax rate, and so they want to buy, investments within their business. It's okay to do that. I think it's good to diversify your income, or your investments. But what other business do you have such control over, where you know your margins, you know how much you're going to be making, if you sell more? So I would reinvest that into marketing and people and equipment and the things within your business. And I think that's the intention with the small business tax rates, that you can grow faster because you hold on to more of that income. And so on the next level, the RSPs, we're looking at 100% retention of your capital. So you put $50,000 into an RSP, it's $50,000. It's not taxed and not touched. 100% you get to retain 100% of that capital. Within the corporation, you earn that 50,000 and they're going to take 11% of that immediately. So you only get to reinvest, 89% of that 50,000 back into your business, which is still really good. It's not 46% or 34% or whatever your marginal personal tax rate is. But um, it is taxed to some extent, but you do get to hold on to a lot more of that to reinvest it. So that's just a great avenue, and that's why incorporation is just incorporating a business is so popular. So that's level two, and I think we see a lot of people incorporating for different reasons, but tax is a strong one. And next is holding companies. So this, you know, I'm not a tax expert. I know these things in a general sweeping um, understanding, but where we've used holding companies in the past is to either consolidate holdings for one particular owner. They have multiple businesses and they want to retain the ownership of that business within one corporation. Multiple corporations underneath. Super, effective way to do that because you can make intercompany dividends tax free. So, one of those companies is, dividending out, $100,000 that year. It doesn't go to the owner individually. It goes to their holding company. And as long as they own more than 10% of that operating company, that dividend can flow tax free. So that's super helpful for personal tax planning, where you're like, this corporation, which I only own 40% of or something, is issuing me a dividend. I really don't need it or want it this year because I'm going to be in a super high tax rate. So a holding company can be really handy. The other, and this is important, and part of the example that I have is cleansing the corporations. It sounds dirty, but that you have your small business corporation for lifetime capital gains exemption. There's certain criteria that need to be met in order to get that lifetime capital gains exemption, and part of that is that the assets of that operating company and the company that you're selling need to be active in business, and they need to have most of their assets used for active business. So if you're sitting on a bunch of investments and cash and things, you could disqualify yourself from lifetime capital gains exemption, which is something we want to avoid. So that's a 2-year runway. So you need to have that company cleansed for 2 years to a certain extent. So really important that if you're planning on selling your business, that you let your accountant know as soon as possible, hopefully with more than 2 years advance notice, so that you can set up a structure like a holding company to move some of those assets to a holding company, so the operating company is cleansed of investments. So super important for that as well. And the last one I'll cover today, is I'll cover that at the end. That one's, yeah. Yeah, okay. Thanks, Barb. I'll see what I've read something about that like 2 days ago, but I don't know the detail around the alternative minimum tax yet. But that's a really good question. I know there's some minimum tax things that have been changing recently, and I don't know the details on that recent budget update. But really good to highlight that. And then, sorry, the next level we will cover is life insurance. And like I said, this is another step up. So, what I like to people to understand is that when you do any sort of life insurance tax thing, really important to get a professional involved in this. The way these are structured can be quite complex, and need to be done in a very specific way so that um, money can be taken out of the business on a tax-free basis, and the tax comes much later. But really important to do that. But I can give the general broad strokes of what to look for and when you might consider something like this. So generally, they're when the business is established, so it's making good money, and there's a consistent cash flow to the business. You can take out life insurance on the key person yourself, and pay into that. And there's a cash surrender value of that insurance policy that can be borrowed upon, and that's not income for the owner, because it's a loan, but it can be useful strategy. But the keys are that you still need to have that income, so you need the money coming in, and you need to pay that life insurance policy, which can be 1,000, $2,000 a month, whatever you sort of decide, with your tax planner. But you need to have that consistent income. So it's not for everybody, because I know cash flows can fluctuate, but you need to have stability in your business. Is kind of the idea there. Now, there's a whole bunch of them, and so I've gone through presentations with people that are involved in these. If anybody needs a referral, please DM me or something. I can refer you to um, professionals that do this kind of work. I do not. I it's if you're going to go down this route, it's good to get someone that just works in this world all day, every day, because they'll know any of the impending tax changes or what CRA looks at, that kind of thing, and be able to work with you directly on what your abilities are to pay these insurance policies and that. But it is sort of a next level thing, and I do want to bring it up here. Not an expert in it, so I won't have the answers for you directly on life insurance policies. But it's good to know that they're available, and it is a well trodden path uh, of tax planning. Um, but not something I can cover in detail, unfortunately, because I'm not an expert. So those are kind of the 4 main levels, and then you may have, okay, but what about, the Isle of Man sort of stuff, and that I call it the level 5 stuff, and that's where, you need extreme wealth in order to get in on these types of schemes, and they're high risk too. So the reason why you see them in the news at certain times is because the CRA is caught up with them. People's names are being dragged through the mud, that the professionals are selling these things, and they're not really above board. And I think you have to kind of do your own accounting internally of, like, if this sounds too good to be true, if it doesn't make sense to you, there's a risk that it's some loophole that's going to be either closed really quickly, or it's um, maybe not even legal in the first place. So be careful of these things. I know there's lots of TikTok advice and things like that. Um, and truth is, we live in uh, a country where we claim our income, and you can get caught not claiming it if you wish. And people get away with all kinds of things. We have a cash economy and lots of things, but what we cover in ours is really all above board tax planning strategies, which are effective for most people. I think there's FOMO for sure when you see schemes on TikTok and whatnot, but be very wary of those. I'm very risk averse myself, but I really check with a professional before getting into things like that. I will talk a little bit too about income splitting, because I didn't put it in here, but I think it's probably hopefully a question that you're thinking about. Is if you have a spouse or a child, or somebody that doesn't have as much income as you, can you spread that income out? And this is one of the not loopholes. I wouldn't say loophole. It was one of the tax planning strategies that was used for years. Is to have a spouse as a shareholder and dividend them a certain amount, so you get to split that income with the corporation. Especially helpful if the spouse didn't make as much money as the owner does. That's been sort of mostly shut down. There's certain specific circumstances where it could be used, such as if your partner works in the business 20 hours or more, is active in the business. That can be a good example where income splitting can work. But then again, they're working in the business, so it's kind of their business too if they're shareholder and they're working in it, which I think is the kind of the point for the government. The other is if they have an economic interest. So if they've actually invested in that business, they put up their own money from their own earnings and their own wealth. But then if they have that kind of income and wealth, maybe there's not a huge advantage to income splitting anyways. So it's kind of a funny thing there. I think one effective way to income split is to have your spouse involved in the business. So paying them a wage is one way to do it. So if there is bookkeeping to be done, and they can do the bookkeeping over the weekends, or that's their you know um, s- that's their actual job, then that can be a useful way to split income with a family. Kids, not so much. I mean, there's you have to pay a reasonable wage to any children, and not a thing that we see a lot. If it's kids under 12, it's really hard to get them to do anything, um, and it would have to be a reasonable wage and something that they would actually be able to do. So it could be looked at, but there is limited income splitting opportunities with child labor. I don't want to say that with having your kids do work and get paid for it in your business. But yeah, income splitting is still kind of a thing, but not nearly as big as it used to be. Awesome. Moving on from that. So I'll go through a couple real life examples, ones that we've seen in the past. Um, we did have a sole proprietor client a number of years ago that business took off. It was doing really well. It was Uh, they sold courses on software development and had a community, paid community to join, and business was doing excellent. Started off as a sole proprietor, and we were doing the bookkeeping, and immediately saw income just going like this, and it was a trigger for us to say it's time to incorporate. And they did have a big tax bill that year, because a lot of that income remained with the sole proprietorship. So I think it was $400,000 of income or something like that. And tax bill on that was quite high. Used RSPs as much as we could, but they were also a new Canadian, so there wasn't a huge amount of RSP contribution space to be used up. So unfortunately, like there was a big tax bill that year. I think they understood that, but got them incorporated immediately, and they were able to buy another website and use some of the tax savings by being a corporation to purchase another asset and to grow their business further, which was fantastic to see, and still a thriving business today. So that's an example of what can happen. Should he have incorporated earlier? Maybe it would have been helpful to save some of that tax, because he didn't live a very lavish lifestyle, um, and didn't need that income. But you limit things as much as you can, and move on and save tax as you can. But that's an example where incorporation can pay off, and did in this scenario, and caught it as early as possible, which is important too. Another one again was another website, actually, using affiliate marketing, and the window of opportunity was a few years wide and was doing really well. This website doing excellently, but they were accumulating. They were incorporated, and were accumulating a lot of cash and investments within the operating company. We're looking to sell within as soon as possible, because again, the window of opportunity seemed to be closing on this type of website. and they had a few buyers in mind, but we had to cleanse that corporation. So we got a tax specialist in to help us. So we don't do tax specialist work here at Avalon. We got a tax specialist in to help with that, and we had to cleanse the corporation, and make sure that the investments were put into the holding company and the operating company remained um, active only. So for 2 years, it had to be 50% or more of its assets needed to be used for active business. And then upon sale, it's going to be 90% plus. So still running that business, and it's all going well. But that's an example where a holding company needs to be created so that he'd get the lifetime capital gains exemption, which uh, $900,000 of tax-free income is nothing to scoff at. So really important there. They did a trust as well and a few things, so we weren't really involved in that side of it. But it's just what's possible when you can find those triggers and get the right professionals involved. Like I said, we don't do tax specialist work, but um, we're able to identify that as an opportunity and maintain it afterwards. Right. So here's the pitch. Join our YouTube channel. Subscribe, and we can do more fun stuff. And we do have some Yeti mugs. So our 10th member, if you become a member, you get one of these. It's a full-on Yeti mug, and it's pretty sweet. Paul's choice. Um, and um, Yeah, so looking for memberships, it's a way to support the channel if you're just looking like, "Okay, how do we support these guys to keep them going?" I'll tell you, the ad revenue on a YouTube channel is almost 0. But, we know there's a good community of people out there that value what we do, and this is just a way that you can support us and help keep the channel going. So that's one way to do it, and we wanna reward you for supporting us, and, we'll get that. So we did have a first member. I think our first member signed up. Muzio. I have to do a shout out to Muzio for supporting us. Thank you, Muzio, as our first supporter. Thank you so much. Super helpful. There's also super thanks and things that you can do on YouTube. No obligation. I mean, we're here. We're going to be here regardless. We love doing this stuff and being helpful as we can. But if you do want to keep the channel as robust as possible, definitely we appreciate any support that we get. So I'll leave it open for our Q&A here. So Barb, in this environment, I don't know the details of the alternative minimum tax. Like I said, I just read something about it in the release about the budget updates, but I don't know all the implications of that. And like I said, not a tax expert, so I'll have somebody explain it to me, and then I'll put it into layman terms here soon. But thanks, Barb. Um, and next gen says we are oh, here, actually, I'm going to highlight this. So this was Barb's question. I'll just put it up here. So speak about proposed changes to the alternative minimum tax. So this is a tax that, if all the other tax things, like you reduce your taxes so much, but you make all this income, they can have an alternative minimum tax, which comes into effect that you have to pay this minimum amount of tax over a period, and it's refundable later if it turns out you don't owe that tax. But there's details there that I just don't. I'm not versed enough in answering that question. So sorry, Barb, but I'll do my best to do some more research on that and hopefully put it in layman's terms for everybody. And next gen. Canadian LLC, I guess you mean corporation. The LLCs don't exist in Canada. So I just wanted to make sure that's clear. So Canadian corporation. Um, oh wait, okay. So Canadian LLC, we work as subcontractors for another Canadian company who serves U.S. clients. We get paid by our Canadian client, but the end clients are in the USA. Do we have to pay? Do we have to pay GST and HST? Okay, you get paid by your. So this gets into supply rules. So where um, uh, where the service is actually being consumed. So if it's in Canada, it's actually the province that it would be, where the service is actually taking place. But if the service is actually, getting consumed in the US, there would be no GST or HST to be charged. So it's really about where the customer is located. And if you sometimes if it's really unclear, like it's this person doing that, and where is it? Really, you can often get a ruling. You can explain the situation to CRA, get a ruling on where whether GST should be charged and what the rate should be, depending on the province that it's in. So that's where I kind of recommend is to get actual like you know detailed advice on that, especially if it's some if the amounts are going to be significant, that you get actually either a CRA ruling to tell you in this situation these are the facts, this is what you should do, or have an accountant with an indirect tax group, um, do an analysis on it as well to give you a recommendation, and they'll put their stamp on that. So that's going to be a bigger firm like MMP or Grant Thornton or bigger firms like that that have an indirect tax group, that can give you a memo, write you a memo on what you should do in your particular situation next gen. So great. Right. Oh yes. Where's the link to join? Yes, there should be right under if you're not maximized on YouTube. There is uh, so Ishioma says, "Where's the link to join?" So yes, it's on YouTube, and there's actually a little join button now. It's 2.99 a month. I would say for a limited time only, probably forever. You can't change the price on it, but we might add higher ones too. See if there's an actual QR code or something. No, I don't have a QR code. Sorry, but it is in the YouTube. There's a little button called join there. Thank you for the question. I was happy to talk about that. Karthik. All right. Can you pay dividends to family members if they are shareholders? Yes, there are restrictions. Like I said, with a spouse, same thing applies for any non-arm's length individual. Um, that you're limited by the ownership and what you can pay to those people. There's still the kiddie tax as well. So paying dividends to children is taxed. You can do it. It's just taxed at the highest marginal rate. So that's been around for a long time. You cannot really make minors, shareholders in your corporation, have any tax advantage there. Um, for adult children, as they call them, for your kids that are of a certain age, there's more rules around that. I'll have to look up our TOSI. Maybe I can post our TOSI discussion. So TOSI is tax on split income. There's specific rules around that, and there is talk around adult children and what they have to do in order to get dividends. Again, it's a bit of a funky thing. You can't just pay dividends to a family member to split income randomly. That's the old school way of doing it that's been closed down. Thanks for the question, Karthik. All right. How long can the company owner borrow money from the company without paying personal tax? Do we have to pay interest to the company? So shareholder loan, we have an article and a video on shareholder loans. So shareholder loans, really, there's not much you can do with these. The money does have to be paid back. It's within the next um, fiscal year, calendar year, fiscal year. I'll have to look that up too. Um, but it's limited. So if you don't pay it back in time, you actually have to go back to when you took out the money and put it in your income for the year that you actually took it out in cash. So you really want to avoid that. And then the deduction is you actually don't get a deduction for that within the company, so you get double taxed on that money. So it's a dangerous sort of thing to play with. You do not want to sort of take money out of the company. What we generally do with our clients, if they've been taking money out of the company, it goes into shareholder account, within that fiscal year, and you can sort of carry a balance over one fiscal year, but it needs to be paid back by the following fiscal year, because the highlight for CRA is that there's 2 years with a shareholder debit balance, i.e., the shareholder owes the company money. And if that's the case for 2 years, I think it's an immediate like alarm bell for CRA, and they come asking about why that balance has been there for 2 years. So really important to pay those balances off, um, and they're because there's such bad tax consequences to having a shareholder loan over that time. And interest doesn't matter. Like, you can't do it unless you can prove that you offer the same loans to all of your employees on account of their um, being a part of the company and not an owner of the company. So I haven't met a business owner yet who loans their employees money like that. So yeah, unfortunately, not really a tax planning opportunity to take shareholder loans other than short term ones. But even then, I'd limit it as much as you can. You could use it as a 1 year stopgap, maybe. Um, but really depends on the situation and um, what your personal income is going to be in a given year. But you do need to pay it back anyways, so it's limited. You definitely, and then they do have series of loans rules. So if you keep paying it back, if you keep loaning it, and pay it back, and then loan it again and pay it back, you're subject to their series of loans rules as well, and can get hit with taxes, extra taxes, double taxation on that as well. So be very careful. Oh, thanks for these questions. That's awesome. Any others out there? I'll hang on for another couple minutes here. But yeah, I think to sum up, I think, thinking ahead about what you want to do with your business, and this goes hand in hand with what I believe so dearly about business ownership, is that you should be rewarded for it. Like, you are building wealth based on the risk that you're taking within your business. So it's super important to think about the long term, about what you're trying to accomplish with that business. And I'm not here to say like you shouldn't pay any taxes, but you definitely don't want to pay more than than you need to. So being smart about it and thinking ahead. There are tax tax planning opportunities that are available for you that are right in the tax code. So you want to use those RSPs, TFSAs, um, using the small business deduction, and um, and lifetime capital gains exemption. Like, these are things that are written into the tax code that are waiting for you to take advantage of, because they are your reward for owning a small business, and don't let them pass you by. Really important to use them. And that's why I don't like to get stuck on crazy, tax planning things. Build a solid business, and you can get rewarded for that. And if you have more wealth than you know what to do with, sure, yeah, go hire a tax lawyer that will, you know, set up something that, may or may not succeed long term, but maybe you'll have so much money that you don't care anymore. It's worth the risk or something. I don't know. It's not the kind of clients we deal with, but uh yeah. SK Home says, can an individual take advantage of the 2023, um, is this the plug-in hybrid electric vehicle CCA? I don't know the answer to that. I'm sorry, SK, SGK. I don't know the answer to that. Can't see. There's not generally separate rules for CCA for corporations and people. Uh, Persons, they're both persons under the law, and CCA rules tend to be similar, but I could be wrong on that. So, uh, yeah, yeah, I don't know the answer to that. I feel like it's maybe a Google one, or maybe ChatGPT knows the answer. Sorry. Um, Gene says, "What kind of services do we provide?" So, yeah, so we are a CPA firm. We do compilation engagements, so we put financial statements together. We do corporate tax returns. Um, we do tax planning, like the things that I'm talking about here. Although sometimes structuring, we'll engage with a tax expert, a tax specialist, because that's what they do day in and day out. We also do bookkeeping. So we do monthly bookkeeping with Zero accounting software. We do training on bookkeeping as well. So that's a big part of our business. Owners that want to do their own bookkeeping, we train them on how to do it. And if they have a bookkeeper already, we can help train those people as well. And we do payroll too. So we have one and a half payroll specialists on staff. They're two full people, but one works part time and one full time at the company here. So we provide those kinds of things as well. Yeah, so accounting, bookkeeping, payroll for small businesses, and we try to package that up into one handy service. Irene, Ontario Health Service business that is HST exempt. Okay, because medical services, but I sell a few $100s of products per year. Yeah, so if you yeah, it depends on the products that you're selling. I don't know what I mean, maybe it depends on the products that you're selling as well, but if they're not exempt, then that portion of your income could be. And it does again, like I would speak to your accountant directly to make sure that uh you'd think about whether it's zero rated or it's tax exempt. If it's tax exempt, you might fall under the 30,000 per year rule with your products and not need to charge GST. But that's something I would definitely get a professional opinion on and have them write out the reasoning behind it and the whole bit. And that's an important thing here. So here on YouTube, general advice, general information. If you want something that you can hang your hat on, really important to engage with an accountant that can do analysis on your specific situation, write you a memo on how they came up with their reasoning for that, and then provide a recommendation. So you should or should not charge HST on those given products. So really important to put that in perspective. That when I stand here and I give general advice, it's one thing, but if I have a client that's asking for a specific advice from me on their specific situation, we would do research on that for that specific situation, come up with a reasoning, write a detailed memo on what that is, so that we have a record of what our thinking was. Because accountants change, people change within accounting firms, all of that, and you want that thinking and that background to be documented. And that's really what we do as accountants. We don't know everything at any given moment, but we can go research things and find out the answer for you. So that's a great question, Irene. I wish I could give you a better answer, but I think it is important to get specific rulings for yourself, um, given the circumstances. And barring an accountant, sometimes it is just a call to the CRA. Their helpline is usually really helpful. Yeah, you just might have to wait for a while, which is a little annoying, but yeah. Oh, Manitoba tax. We do companies from Manitoba. So there's a separate schedule for Manitoba. We do RST returns as well, Gene. Yeah. All right. One last question. I do have to run here, but Karthik has a friend who currently has a side business as a sole proprietorship alongside her regular employment. She's considering incorporating um, general rules of thumb. Yeah. So again, more income. So number one, or liability. If your lawyer tells you to incorporate because of liability purposes, just go ahead and do that. So speak to a lawyer. I'm not a lawyer. There may be reasons why the sole proprietorship should be incorporated for legal reasons. So just set that right aside. Um, the other is if she's building to sell it one day, like it's going to be useful to sell it, then it's a no-brainer. Incorporate that business because you'd be able to sell the shares and get lifetime capital gains exemption. If it's strictly income, and then my analysis is generally, does she have more money than she knows what to do with? So she's filled up her RSPs, she's filled up her TFSAs, she still has all this money coming in, it's getting taxed at high tax rates. What is she to do? Incorporate the business and retain more of that capital for longer. So that's kind of the stages there that I go through. Um, but yeah, that's my general like analysis on whether somebody should incorporate. Awesome. Well, thanks everybody for joining today. I hope it's been insightful, at least maybe give you a takeaway or two. Really appreciate you joining and supporting the channel. And we'll see you in the new year. You can follow along, get updates with this code, this QR code. Lori will remind me. Um, and we can send you an update on when the next live will be. It'll be in the new year, and we'll keep these going. I find them, yeah, fun and engaging, and hope you do too. So thanks again very much, everybody, and we'll see you in the new year. Happy